There is heavy leverage in the markets of India today. Hello, everybody. Welcome to this YouTube video on understanding different aspects of leveraging. And let's also explain how deleveraging can cause the market to fall down even faster than it otherwise would have. I'm your learning partner Sushila Hariharan, and if you're interested in a career in hedge funds, global markets, and investment banking operations, do subscribe to my YouTube channel where we provide content-centric, research-focused videos on topics such as this. Remember, financial institutions, retail investors are borrowing heavily in the markets to trade in the markets. Okay, so when will we borrow money to buy an asset? We will borrow money to trade or to finance a transaction when the cost of borrowing is low and the returns from the appreciating asset is very high. Let's say, for example, I'm borrowing capital at 10%, but I have invested in an asset that is giving me 20% returns. I'm very happy with this leverage. Why? Because I'm borrowing, my cost of borrowing is at 10%, and the money that I have borrowed at a cost of 10% has been invested in an asset that has given me a return of 20%. So obviously the returns that I'm getting from the investment is 20%, and it is being financed at a cost of just 10%. So I'm making a lot of profits. I don't mind borrowing more capital. So I will borrow more capital so that if I borrow more capital, I can invest more, and if I can invest more, the continuously rising market will also give me greater returns. As it gives me higher returns, my cost of borrowing is not only covered, I'm actually generating a profit over and above the cost of capital. I'm absolutely delighted. What do? I borrow more. And the story continues of many of the investors like this. That is, you borrow capital and invest in marketable securities that are traded in the market. As long as the cost of capital is low and the returns generated from that asset is higher than the cost of capital plus your expected returns, then everything is very nice. Everything is very happy. All the influencers are happy, all the traders are happy, all the hedge funds are happy because they have managed to not only cover the costs, but they've also generated a return over above that. But what happens when the market starts sliding down? When the market starts sliding down, or the market is range bound, that is, it doesn't have a spectacular upward movement nor a spectacular downward movement, typically most investors will think about the returns that they are getting from the market. What happens? The investor is now not earning that 20% return from the market. In fact, they're earning much less than that. Let's say they're earning only about 8% returns from the borrowed capital, which has been borrowed at 10%. So investor who was earlier borrowing at 10%, investing in assets that generated 20% return, now finds that the asset is generating only 8% return. That means the investor is borrowed capital at 10% and they're investing in assets that are generating returns much lower than the cost of capital. So the investor is neither recovering the cost of capital nor are they, forget returns, they're not even able to recover the cost of capital. Now this is a very, very dangerous situation to be in, because what does the investor think? All investors will think the same, that why should I borrow capital to invest in an asset that is depreciating? Let me sell off the asset and repay back the capital. This process of selling off stocks in the market and repaying borrowed capital is called as deleveraging. So leveraging props the market up because you're borrowing capital, investing in assets that give you great returns. Deleveraging is you're unwinding those loss-making positions, and when you're unwinding those loss-making positions, you're doing it because your cost of capital is not recovered. So not only is it a loss for you as a trading loss, but you also have to pay the lender of capital the interest cost. This is a double whammy for investors who trade heavily with borrowed capital. And when they trade heavily on borrowed capital, when the market starts sliding, then even if there's an interest rate cut, they will not be able to recover any kind of profit from this situation, because the prices are already falling. When the prices are following, they will have to unwind heavily leveraged positions, and they will do it at any price. So they will take a hit because they are not able to see, the profits at the end of it. They're seeing losses, so they look at, let's stop loss our losses. So they do an SL point of exit, and when they do an SL point of exit, SL standing for stop loss exit, they are selling the stocks, and whatever capital they're getting from it, plus they might be putting their own capital into it, they're repaying back the principal to the lender of capital. This deleveraging causes double, triple, quadruple kind of effects on the market. Because leverage is now is absolutely eliminated in the market, investors now have much lesser capital to play around with, right? So they have lesser capital to play around with because they are not borrowing, it's their own funds that they're using. They become cautious, they become more worried, they become more worried about what are the kind of assets they are investing. Okay. Second, the heightened cost of capital, the high rate of interest, the high cost of capital, even if it is reduced by 25 basis points and 50 basis points, doesn't justify the rate at which investors are borrowing capital. Okay, and literally they see no end at that. They don't see the end of the tunnel. They don't see the light at the end of the tunnel at all. They think they are in a tunnel and they don't see the light at the end of the tunnel. They cut short their positions. So when they cut short their positions, they're taking a hit on the capital. So capital loss is significant in these cases. The third, investors, because they have now lesser capital to invest in, are more cautious. They become a little skeptical, they become a little worried, they are not as aggressive as they were earlier. So deleveraging from different markets is a big problem, but it is the only sane way to stop this uncontrolled borrowing, this relentless borrowing in order to trade in speculative assets. I'm not saying that it's bad or it's good, but it's the only sane way to bring a stop to it, where people take a pause, people take a breather. It's like a marathon. When you're running in a marathon, you go at higher speeds, you moderate your speed, you go at a lower speed, everything happens, then you bring out a sanity check. This is the sanity check. Deleveraging helps investors recoup not all of their losses, but at least save the capital that is left. It eliminates the cost of capital, it eliminates the borrowing that is needed, and deleveraging brings about a more sane, sensible, and a more practical approach to the way prices should be moving in the market. Does that mean there will be no frenzy again? Of course there will be, but that is another story for another day. But that's another cycle that will take place. But at this point of time, deleveraging adds to already falling prices in the markets, because you're selling at any point, at any cost. You're selling the trading positions, you're selling out your assets so that you're able to recover some bit of capital in these cases. This is my video for deleveraging. Thank you so much.